Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, I'm going to share with you guys 7 companies that according to Morningstar valuation is right now either fairly valued or undervalued. Now, this is not your typical, some of these companies are not straight up undervalued at this point in time. These are some of the best companies in the world, and you're going to have to do a little bit more digging in order to make sure that you understand the risk that you're taking if you were to invest in some of these companies today. And that's just kind of giving you a little bit of warning, because despite the information that I'm about to present to you today, some of these companies are, I believe, slightly overvalued or maybe have gone up so much over the last 6-7 months, so you have to be really careful. But according to Morningstar valuation, Morningstar uses discounted cash flow models where they look at the company's financials, the past data, and sort of a forecast to like what's going to happen in the future. Again, that's an estimate, so they can be wrong. So what you would have to do is make sure you add at least 5 to 10% of margin of safety depending on the stock itself, and I will tell you exactly as we go along which ones I will add 5 or which ones I would add about 10% or higher in terms of margin of safety. If you haven't pressed that like button already, please do so. It really genuinely helps the channel. It takes a lot of time and effort to put these videos together for you guys. I would genuinely appreciate if you can do that. If you haven't joined us at the Patreon account where we share a lot of information, then of course join us. Also, you can send me your portfolios and I can have a look at it, inshallah, just to kind of give you some feedback. So there's on the Patreon account, there's a spreadsheet that you can download and then just basically fill in and then send it to me, and then inshallah I can look at it and I can give you some feedback on your portfolio and so on. So let's get started. So just this week, with just yesterday, the market was doing okay up until yesterday. We've had quite a few reds yesterday. For the 1 week, as you can see here, we're now in the red. We were in the green at some point in the morning yesterday. For 1 month, we are sort of flat, if you like. But when you look at the 6 months, this is what surprised me. Look at the S&P 500, 22%. Look at the Nasdaq 100, almost to 30%. So we've gone up a lot. So that's one of the reasons why I keep saying to you guys, yes, there might be opportunities out there, but you just need to make sure that you add your margin of safety into some of those companies that you're buying, because they've gone up a lot. And for the 1 year, as you can see, 11% for the S&P 500, the Dow Jones about 7%, the Nasdaq 100 about 15%, which is absolutely amazing. The FTSE 100 has done a really great job. I think European companies are doing really well generally. So Europe is actually doing good overall. The FTSE 100 14%, that's absolutely amazing. I don't think it's done that for, I don't know, for however many years. And the final thing is fear and greed. As you can see here, we're now extreme fear. That's where we're heading, it looks like. And I hope we get there. I hope, and what I mean by that is I don't hope basically things go completely crazy, but I hope that we have a little bit of pullback in the market, because that would give us a great opportunity. So let's get started with these 7 companies. Of course, as always, I'm going to give you a brief information about each one of the companies, but please do your own research as we go along, and just make sure that you are, you understand what these companies represent. The first one is the Fortinet. This is one of the companies that we've talked about quite some time. It has a wide moat, is in the cybersecurity side of things. They have a cybersecurity platform. They have basically with regards to the moat, they have high switching costs. So for that reason, it's quite difficult for companies to move away from this company. With regards to earnings and and cash flow, they have a strong recurring revenue, but the business is very sort of a cyclical IT budget. So it depends whether companies are investing a lot more money into their IT, and this company will do well. So it's a little bit cyclical in terms of that. And with regards to some of the risks, it's lower billings, competition from Palo Alto Network, CrowdStrike, and micro IT spend sort of a thing. All of these things can be, risk for these businesses. But when it comes to profit margin, return on equity, return on invested capital, one of the best out there. Free cash flow is, great right now. They're expecting the earnings to grow by 11%, revenue about 12%, 30% when it comes to that Morningstar valuation. So 30% upside from where we are. If we look at fast graph, when we use the normal multiple, the company has been trading over the last 5 years about 42, which I don't think it should be used right now. So if we were to use the forward PE for this company, which is about 33 sort of, you could still make about 26% return on invested capital. So or total annualized rate of return of about 11% for the next 2 years, which is quite quite good, 11%. So but that's using the about 33 PE if you like. But if we were to use the normal estimate, because this is what they're expecting the earnings to be, about 11% and then another 11% for the next 2 years, then of course the stock seems very much overvalued. And this is why I'm saying to you guys, you need to be careful with some of these companies. This one, there's no doubt the fact that this company is undervalued at this point in time. This is one of my favorite companies out there. They have a wide moat because the ratings, the indices, the data franchise, and with recurring revenue, that sort of a companies find it very difficult to switch from this company once they are in that sort of a eco environment side of things. And then with regards to earnings, so they have a very predictable, reliant basically income if you like, and the valuation seems very cheap at this point in time. But again, it depends on this company gets exposure to like market cycles. So if we're doing really well, the companies, the whole world is doing great and companies are issuing debt and all of these things, the company will do well, of course. But right now it seems it's about 17% undervalued at this point in time. With regards to profitability side of it, how management are doing really great, $5 billion of free cash flow, and they're expecting the earnings to grow about 12% and then revenue about 7%. So that's 17%. Even if you give yourself 10% upside, sort of a margin of safety, you will still be fine. So currently the company has blended PE of 28, and if we were to use the normal multiple, which is about 31, where the company has been over the last 5 years, you will be making about 16%, 17% total annualized rate of return. And even if you say, okay, for example, the company does not deserve, in fact, let's just check what the forward PE looks like for this company. That'll give us at least an idea of where. Okay, so it's about 28. So if we even say we're using that 28 sort of a PE moving forward, you can still make about 11% moving forward. So again, another great company. I genuinely think this is undervalued at this point in time. So again, of course, do your research. You might be thinking, what the heck is this guy doing? Has he lost his marbles? Look at it, Broadcom. Broadcom is right now, according to Morningstar valuation, a fair valued stock. 325 is what they expect the price to be. 324 and 63 is where it's at right now. So according to them, you can buy it right now. But of course, that you have to be careful with this one because it's gone up a lot over the last whatever years. In fact, we can check that one. Let's have a look at the last just 1 year, 74%. Last 5 years, 746. A strong buy from Wall Street, which is interesting. 36 strong buy, 7 buys, and a lot of that comes from because of this massive growth expected, to grow this much every single basically year for the next couple of years. And I love the fact the company is not just the sort of the semi side of things. They've got the software, VMware. They have a strong free cash flow generation, steady margins. This company is in the right environment right now. And according to this one, they are saying it is basically fairly valued at this point in time. If we go here and have a look at also, I wouldn't be surprised if it's very much overvalued. If we use the estimates expected, so about 40%, 25% for the next couple of years. This is very interesting. Wow, I didn't actually look at this. Okay, so 9% total annualized rate of return if you were to buy this stock based on the expected earnings for moving forward. That's normal estimate. That's estimates. If we use the normal estimate, which is basically where the company has been trading over the last 5 years, that's 17 PE. Okay, it is expensive. So it's the other way around for this one because of course the company has been cheap for quite some time, and that's when I started buying the company. But if we use the expectation, like the expected earnings side of things, you could be making still at least a 10% per annum for the next couple of years. So if you invest $10,000 today, you will be making over $2,000 in the next 2 years, which is quite good. The next one we're going to look at today is Nvidia. Again, you might be thinking, what on earth is going on here? But according to Morningstar valuation, this company has an upside of 4% right now. $190 per share is where they think the price should be. 183 is where it is right now. Again, another great company. We don't even need to say much about this company. It has a very, has a wide moat that nobody can touch, in my opinion, with the GPUs, with the CUDA ecosystem dominance that they've created over the last whatever years. The earnings are very explosive but very volatile at the same time, because anything can happen. The AI cycle volatility can actually get in the way, regulatory situations, the supply chain, so they might not be able to fulfill all the orders that they've taken. There's a lot that can go wrong, which means the company can actually come down quite a bit. So it takes one news that says, Nvidia cannot actually produce the chips in fast enough, or whatever the case might be, to actually bring the price down. Now, if we go back here and just look at Nvidia, let's see where is that. If we're using the estimates, which is that's 41%, 15% in the next couple of years. If you bought the stock right now, you'll be making about 9%, which is very interesting. So by 2028, you will have basically your 10,000 will become 12,160. If we use the normal multiple for this one, look at this. Okay, you will be making your 10,000. Okay, but that's 48 PE, which is doable if it continues the way it is right now, because right now it has a blended PE of 45 according to this. And if we use this one here, if we go and VDA, let's see what is the forward PE looks like for this one. It's 40 right now. So if we're using that, you can actually make your 10,000 will be almost a double, because you'll make 97% or $9,742, which is very, very interesting. Now, the next one that we're going to look at today is Air Product and Chemicals, another company that I have had in the portfolio for quite some time. Right now, it's about 25% upside, has a 25% upside from where we are. $321 per share is where they think the price should be. If we go in here and have a look at the company using normal PE that has been trading, basically right now, it's expensive if you use the estimates, because that estimate is about 8%, 7%. If we use normal multiple for this one, that 26 right now is about 21 blended PE here. So if we use that you will be making about $6,000 on the top of your 10,000 invested by 2028. So another one that seems cheap, but again, add your margin of safety depending on the company. You might be thinking this guy is going absolutely crazy, but look at ASML again. 1% should be 1%, has a 1% upside from where we are, and I think a lot of that is because it came down quite a bit. I think it was yesterday. 950 is basically where they think the price should be. Now, if we go in here and I want to look for a ASML, let's see. So it's a buy from Wall Street, 22 strong buys, 4 buys, 11 holds, and 1 strong sell, and it has 0% upside from where we are, $938 per share. That's almost exactly where it is. And if we go here, ASML, okay, let's see what this tells us. So if we use a normal estimate, of course it will be expensive because these companies do not normally do that. Normal multiple here, oh wow, okay, so it's about 21% up, 22% upside from where we are. If we were using that PE of 40, that's where it's been. Okay, the forward PE for this company looking at right now is about 33. Even if we were to use that 33 PE, okay, you still be making 10%, so your 10,000 will become 12,000 for almost 500 in the next couple of years. Now, the final company we're going to talk about is, again, another one that you might be thinking is very expensive right now, but according to Morningstar, $720 per share. That's about 12% upside from where we are right now. $641 per share is where they think the price should be. Every single one of these companies has a wide moat. That to me is very important, because that adds couple of percentages for each one of these companies, because nobody can actually come into those sort of markets and take over, if you like. But right now, expected to grow about 14% when it comes to EPS, 13% when it comes to revenue side of things, 12% upside from where we are. A great company. Let's go on here. In fact, we're going to go on to this one and have a look at the company. The forward P is about 27. Let's see what Wall Street is saying. 19 strong buys, 6 buys, 7 holds and 1 sell. And then we've got about 26% upside from where we are. $811 per share is where they think the price should be. Earnings expectations for next couple of years. You can see 13%, 15%, 15%, and so on. Revenue side of things, 12%, 13%, which is absolutely fine. If we go in here and have a look into it, if we use the estimate of that 13%, 14% sort of, it seems very expensive. If we use the normal multiple, which is about 38 PE, where it's been, that's basically where the average has been on the last 5 years. That's the reason why we look at this. Right now, if you bought this stock right now, you'll be making about $8,257 by the end of 2028, by July 2028, which is quite nice. If we use the PE, forward P, I think was 27. That's actually quite cheap for this company. That's interesting. So if you bought this stock right now using that, you will still be making about 10%. So about $12,854 is what you would have at the end of July 2028. So that's the 7 companies I want to share with you guys. I want to be honest with you guys and say every single one of these companies is a wonderful business, but you want to buy them at a fair prices or undervalued at this point in time. Now the market can easily change. The Nvidias, the Broadcoms, and ASML can change things very quickly, especially because of AI and so on. These companies have gone up so much over the last. So if we look at, for example, year to date, we're talking about 35%. That's a lot. If we look at Nvidia, for example, a year to date is up 36%. If we look at S&P Global is down, I know that. Into it, let me have a look at actually just 2%. That's why I was actually surprised. For the whole year, it's about up 3%, which is quite nice. But 6%, the 6 months is about 11% up. But yeah, so this one is really interesting. This is a company that I've had in the portfolio for quite some time. Took some profit off the table at some point, and that was a mistake. I think I shouldn't have sold it. I should have kept it, but I had so many IT companies at that point, or technology companies. I just had to reduce the risk, and I'm glad I did it, because I used that money to buy other companies that have done well for me over the years, and potentially might be looking at this one again. But that's the 7 companies that I want to share with you guys. Again, there are opportunities in the overall market. Despite what you hear and what you see, I wouldn't worry too much about the noise. Just buy the companies that you believe that are doing really well. That's going to be in your portfolio for whatever years, and just leave it alone. And you can pause the video to have a look at the Sharia compliance side of things. Have a wonderful day. Assalamu Alaikum.